Assalamu alaikum. A very good day, audience. This is Mustafa Mirchawala, your SBR trainer. The objective of today's class is to do some revision related to SBR for your latest attempt, right? And we'll be solving from first class. We'll be starting very latest past paper, that is December 2020 attempt, right? Okay. And one more thing for you guys, that as these are last days, so I would recommend you to do a lot of reading, because this SBR paper is almost 85% theory or 90% sometimes theory. So do read all the articles, for from accaglobal.com, that they are very, very relevant. In all examiner reports, they have said this. Plus, read the examiner report as well. Right? Can't you listen? Can you guys listen to me? Hello? Yes. Okay. Thank you. So we'll be starting from the question number one of December 2020 attempt. Those who can't listen, they need to change their settings. Okay, they need to change their settings. Connect with audio. And we'll be sharing some of the tips of the last attempts position holders, those of my student who scored position in September and December. So I'll be sharing their experience, how did they study, right? Okay, so now let's move to the question number one. This question you can get from accaglobal.com as well, and within few minutes we'll be sending you the WhatsApp group link, so you can join that WhatsApp group for future classes, future revision days, and also these exam material I'll send all everything. Just wait 1 minute. Let's start with question number one. Now be very attentive. And first of all, keep one thing in mind, that this SBR, this professional paper, why the voice is slow? Is the voice perfect? Yes, it should be perfect. Please change your setting. There must be some problem in your settings. Those who can't listen. Okay. Now, so first of all, keep one thing in your mind, that this is a professional paper. There are things which are very tricky. There are things which are different from previous past papers, because they test real life things. Okay. And in real life, they prepare you for real life. So when you go in real life, every day you find a new transaction. So it's very natural that in this paper you may get something new in each and every paper. Okay. So don't expect everything what you have studied in the class will come in the exam. Okay. First of all, this perception is very important. Now, let's start with the first part of this December 2020, right? At 30th June X7, at 30th June X7, Sugar Company has investments in several associate companies. Several associate companies. Now that means we are Sugar Company and we have many associates. We have many associates. I hope you remember the meaning of associates, on which we have, significant influence, on which we have significant influence, on which we have significant influence, right? Now, including floor company, one of the associate is floor company. Now, first exam technique, this examiner has written this in the examination report. When they are openly saying, that this company is associate, so now you don't need to define associate. Now you don't need to define associate, that associate is a company in which we have significant. No. Professional paper. They are not asking the meaning of associate here. So if you write these lines, that associate is a company in which we have significant influence, blah blah blah, no marks, no marks, please. Including floor company. Now on 1st July X7. Now wait. See the year end first. The year end is 30th June X8. For this question, the accounting period for this question, the accounting period year end for this question, the accounting period year end is 30th June X8. So when the accounting year end is 30th June X8, that means the accounting year is starting on 1st June X7. Okay, so your accounting period is 1st June X7 to 30th July X8. 1st July X7 to 30th June X8, sorry. So that means on the first day of accounting period, this transaction happened. See, on 1st July X7, Sugar Company acquired additional shares in Floor Company and obtained control. Now, think over it. Previously, it is written that this Floor Company is your associate. It is written in the question that this Floor Company is your associate. And now we have bought more shares. See, they have written acquired additional shares and we got the control. So in simple terms, this first paragraph is about step acquisition. This first paragraph is about step acquisition, and the case is A to S, associate to subsidiary. Previously, this floor company is your associate, and now we are gaining control. We are getting control. Now we are getting control in this company. Right? Okay. So the case is A to S. And for your remembrance, now that this is the change in status, now we'll have a change in status here, right? Okay. Now, on 1st of October X7, Sugar Company also acquired an associate butter company. This is other than floor company. The floor company is now our subsidiary. From 1st of July X7, floor company is now our subsidiary. But we are keep buying new companies as well. The group is preparing consolidated statement of cash flow for the year ended 30th June X8. So now, principally, this question is about consolidated cash flow, the most technical area of your consolidation syllabus, but the most interesting one, the most technical and the most interesting area, that is consolidated cash flow. Okay, right? Now this is all about, dear student, this is all about the story of floor company. Listen the story very carefully, each and everything. Now just use your brain. Look at here. Just think, you bought floor company few years ago. You bought floor company 40% shareholding few years ago. So definitely you must have paid COI. You must have paid some consideration, and that is called COI. Now, a 40% shareholding in floor company was purchased several years ago at a cost of 10 million. See, this is your COI. You paid COI 10 million. The investment gave Sugar Company significant influence. See, openly they have used the word significant influence, so you don't need to worry about it. This was your pure associate, right? Now, the consideration to acquire additional 3 million shares. Now, very, very interesting. We already had 40% shares. and now we bought 3 million shares, which is equal to 30%. Can you guys calculate the maths? We bought 3 million more shares, which is equivalent to 30%. When, listen, when 3 million is equal to 30%, can you tell me how many total number of shares are? When 3 million is equal to 30%, can you guys tell me how many total number of shares? Can you calculate the 100%? 100% then 10 million. 100% is 10 million. 100% is 10 million. When 3 million is equal to 30%, when 3 million is equal to 30%, then 100% is 10 million. So in simple words, this floor company has already issued total number of this floor company has already issued total number of 10 million shares. Okay, and previously we had 4 million, and now we are buying 3 million more shares. 3 million, the 30%. Okay, so now we'll have 70. Now we'll have 70% shareholding. Now in floor company on 1st of July X7 was in two parts. Now we are buying additional 30% shares by paying two types of consideration. We are buying additional 30% shares by paying two types of consideration. The number one is cash, and number two, 1-for-2 share exchange when the market price of sugar was 6. Listen, very interesting. The additional 30% shares we are buying, and for those 30% shares we are paying two types of consideration, the cash consideration and the shares consideration. But my dear student, open your eyes and look at your screen. The cash consideration is not given right now. There is a cash consideration, but that is hidden. That is what we need to calculate. That is what we need to calculate, because this is the question of reverse working. This is the question of reverse working. This is the question of reverse working. Now, 1-for-2 share exchange when the market price of sugar shares was $6. 1-for-2. That means for every, listen here, for every two shares, of S company, we will be issuing one share of P company. Okay, for every two shares of S company, we will be issuing one share. So whatever shares from S company is coming, we'll issue half. Whatever shares from S company is coming, we'll issue half, right? So how many shares right now? We are buying 3,000 shares. See, this is the number, 3 million shares. 3 million means 3,000 shares we are buying from them. So what is the half of 3,000? What is the half of 3,000? It's 1,500 shares. So the new shares we are issuing, as a consideration, the new shares parent company is issuing as a consideration is 1,500 shares. And what is the market price? What is the market price of each share? It's $6. So can anybody calculate the value of shares consideration for me? Can anybody calculate the value of shares consideration for me? Yes, we are just issuing 1,500 shares. Multiply by the per share price is $6, so it's 9,000. We are just issuing 1,500 shares, and the per share market price is $6, so it's 9,000 is your shares consideration. 9,000 is the shares consideration. Okay, but my dear student, the cash consideration is missing. The cash consideration is missing, for sure it's missing, and that's you have to calculate. Now in floor company, the floor which was previously your associate and from now it's your subsidiary, it's going to be your subsidiary. In floor company's individual financial statement, the net assets mean the packet of equity. The net assets had increased by 12 million. In simple word, this is post retain earning. This is post net assets or post retain earning, you call it. Between the two acquisition dates, the carrying amount of floor net assets on 1st July X7 was as follows. Now, at the date of takeover, as on 1st July X7, as on 1st July X7 we are going to take the control. We are going to take the control of this floor company. So definitely on 1st July X7 we will be calculating goodwill. We will be calculating goodwill of floor company. And for goodwill calculation we need fair value of net assets. We need the detail of net assets. So this is the detail of net assets. See, this is the detail of net assets. Now we just took over the company and we called subsidiary companies management send the SOFP. So they send this SOFP. But you know one thing, dear students, you know one thing, sometimes we need to do fair value adjustment. It's very old thing. Sometimes we need to do fair value adjustment at the rate of takeover. So let's see, is there any fair value adjustment? Yes, there is. The carrying amount of the net assets at 1st July X7 were equal to the fair values except for land which had a fair value of 600 above the carrying amount. 600 above the carrying amount. So this is basically upward fair value adjustment. This is basically upward fair value adjustment. Now use your brain. Listen, your carrying value of net asset is 35741. Your carrying value of net asset is 35741. And if you need to bring this carrying value to fair value, you just need to add 600 in it. You just need to add 600 in it. And when you add 600 in it, you will get the fair value. When you add 600 in it, you will get the exact fair value of net assets. You will get the exact fair value of net assets. Okay. I request all of you to give 100% efforts, please. 100% efforts. Be very active as these are technical exams. Now, we are going to take over a company. So definitely we need to calculate goodwill. And if it is a full goodwill method, if there is a full goodwill method, then fair value of NCI is also needed. Fair value of NCI is also needed. So read it. The sugar group values non-controlling interest NCI at fair value. So that means it's full goodwill method. And to value, read the word, and to value the share price of floor company at 1st July X7 is 3.8. Very important data. We need to calculate fair value of NCI using the share price of S company, which is 3.8. One more thing. This share price should be used to value NCI. First thing, at that date, and to value the initial 40% equity interest of floor company. Hope you remember this case A to S. We are shifting from associate to subsidiary. This is basically the change in status. This is basically the change in status. And whenever there is a change in status, you need to bring the existing investment to fair value. You need to bring the existing investment to fair value. I hope you remember this rule. Or you can satisfy your brain like this, that it's like you just sold all the existing investment. You just sold all the existing investment and you bought it at fair value. You just sold the existing investment and you bought it at fair value, because this is the change of status. So this is the requirement of IFRS 3 business combination, that at the date of step acquisition and whenever there is a change of status, whenever there is a change of status, you need to bring existing investment from carrying value to fair value. Okay, and I'll do it, don't worry. Okay, but for that fair valuation you need to use this share price. For that fair valuation you need to use this share price of 3.8 per share. You need to use this share price of $3.8 per share. Okay, now first time they have ready made given you the goodwill at the rate of takeover. Definitely you calculate goodwill on 1st July X7 was correctly calculated. See, they have given you the goodwill calculation. That means some balancing thing you need to calculate. And that is the COI, cost of investment, has been correctly accounted for in the consolidated statement of financial position. Okay, so now I'm giving you 1 or 2 minutes. Just read this data, or if you want to take a pic, you can take, because now I'll move the screen. Now I'll be moving the screen. What is the requirement? First read the requirement. This is the requirement. Draft an explanatory note to the directors of sugar company addressing how the initial 40% investment in flour company and the additional purchase of the equity shares on 1st July X7 should be accounted for in the consolidated financial statement, including the statement of cash flows, using the goodwill figure of 2259,000. This is the next requirement. This is the next. Using the goodwill figure of 2259,000, calculate the cash paid to acquire the control. See, one thing was missing in this whole story. The cash consideration was missing. In the whole story, the cash consideration was missing. Okay, and include a brief explanation as how that cash should be accounted for in the consolidated statement of cash flow. Yes, as we are buying a running business, as we are gaining the control, so this is also investment, this is also investment, this is also investment, this is also investment, right? So it will go in investing activities. Buying a subsidiary or buying an associate or buying any shares, this is basically investment. So this investment goes in investing activities, this investment goes in investing activities. Okay, right? Read the requirement. Still you have time, still you have time. Go slow, don't, no need to rush. Okay, now look at here, look at here. Just assume you bought the company first time, you bought the company first time here, you bought the company first time few years back. Floor company, listen, and you bought it for 10,000. You have the picture of the question, you can see you bought it for 10,000. Now from that date, you have in this whole region, you have significant influence, you have significant influence, that is 40% shares. Okay, and now this is 1st July X7, the very first day of your accounting period, the very first day of your accounting period, and this is your accounting period. See, this is your accounting period to 30th June X8. On this date you bought 30% more shares. On this date you bought 30% more shares. So you already had 40, you already had 40, and then you bought 30. You already had 40, you additionally bought now 30. So in on this date you, on 1st July X7 you got the control. Okay, that's very easy. Now, first of all, we all must know till this date, we should do equity accounting. As in the previous years, we this company was just your associate. So that's why you have to do equity accounting. And how we do equity accounting? Carrying value of invest, one line adjustment, carrying value of investment in associate. And how we do it? COI, we write COI and add COI, add post retained earning of a company, post net assets of a company, multiply by your holding percentage. In this question, they have also given you the post retained earning. In this question, they have also given you the post retained earning. If you have the picture of question, I told you to take the pic. The post retained earning was, the post retained earning was 12 million. The post retained earning or post net asset was 12 million. So how you'll be calculating carrying value of investment in associate? COI, this is COI, this is COI. Add post retained earning of a company, multiply by your 40% share. Add post retained earning of a company, multiply by your 40% share. This is how you will be calculating carrying value of your investment in associate at this date. Listen, at this date, carrying value of investment in associate, carrying value of investment at this date. Okay, now once you calculate, listen to me, once you calculate the carrying value of investment in associate at 1st July X7, now this is the requirement of IFRS 3 to bring this existing investment to fair value, to bring this existing investment to fair value. And I'll tell you how to calculate fair value. Don't worry, the share price is given. Okay, fair value. And when you will be shifting this carrying value to fair value, and when you will be shifting this carrying value to fair value, you will take the whole difference in P&L. You will be taking the whole difference to profit and loss. You will be taking the whole difference to profit and loss, because this is the case of change in status. This is the case of change in status from associate to subsidiary. That's the change of status. That's the change of status. Okay. So this is how we'll be progressing. This is how we'll progress. One more thing. These, as we have already calculated from the question, that subsidiary company has issued total 10 million shares, 10 million, and we already have 40%. We already have 40% means 4,000 shares. We already have 40 million means 40% means 4,000, means 4 million shares, means 4 million shares, right? Okay. So we already have 4,000 shares. So if I want to calculate the fair value of this existing investment, if I need to calculate the fair value of this existing investment, I'll simply multiply these 4,000 shares with the share price, that is 3.8. With the share price, that is 3.8, I'll get the fair value. I'll get the fair value. Okay. Now, wait, let me calculate the carrying value of investment in associate. This is COI 10,000. Add share of increase in net assets of floor. This is 12 million means 12,000 multiplied by your holding is 40%. So this is 4,800. So carrying value of investment in associate equals, my dear student, 14800. Okay, 14800. Carrying value of investment in associate at 1st July X7 is 14800. 14800. Okay, this is what I taught you on that sketch. Now the next requirement is you need to bring this investment to fair value. You need to bring this investment to fair value. How can you calculate the fair value of this investment? How can you calculate the fair value of this investment? Listen. Fair value of existing investment. Look at here. Look at here. It's easy. This existing investment is 40%. This existing investment is 40%. Okay. 40% means 4,000 shares. So we already have 4,000 shares, right? And can you tell me what's the share price? What's the share price of this investment? What's the share price? Per share price of S company is 3.8. Share price is 3.8. Can you multiply 4,000 times 3.8? Can you multiply 4,000 times 3.8, please? It's 15,200. It's 15,200. Now use your brain. Right now your carrying value is 14,800, but the fair value is 15,200. Fair value is 15,200. This is the requirement of standard. You have studied. Obviously, you are taking revision days now. This is the requirement of standard to bring existing investment to fair value. Existing investment to fair value. So now you will be making the entry. See this. How much increase you need? How much increase you need? You need 400. Investment debit 400 and P&L credit 400. Investment debit 400 and P&L credit 400. Okay, don't forget this entry. Don't forget this entry, because in this question finally you have to make the cash flow as well. Finally you have to make the cash flow as well. Okay, all of you are requested to join the WhatsApp group. All of you are, we have sent the link. We have sent the link of WhatsApp group in the chat box. Please join it so that you will get the all future updates of classes and all. Now, dear students, we need to write some notes. I've already written it some points so that we just spend our times in understanding or everything. This is the case of step acquisition from associate to subsidiary, from associate to subsidiary. As this is the case of change in status, change of state, that's why existing investment should be recorded at fair value. We need to bring the existing investment to fair value with changes taken to P&L, with changes taken to P&L. Now, just for the understanding, it's like disposal of existing investment and then reacquired at fair value, till 1st July X7. We know equity accounting should be applied for floor company, because till 1st July X7 this company was your associate. Till 1st July X7 this company was your associate, right? Okay. Now, how are we going to calculate the goodwill? This is the pure format of goodwill calculation. See, just look at the breakup. We already had 40% or 40%. Okay, we already had 40% shares. We acquired further 30% now. So 40 plus 30, 70, and 30% shares belongs to NCI. So the three parties are here. See, the three parties are here. Fair value of existing investment. Fair value of existing investment is 15,200. Okay. Fair value of existing investment is how much? 15,200. We just calculated it. Now, listen, students, this is additional 30%. Now we are buying additional 30%. For additional 30%, we are paying two types of consideration. For additional 30%, we are paying two types of consideration. One is shares consideration, one is cash. Shares consideration I have already calculated with you, and that was 1500 shares times $6. That is 9,000. Okay. Now the cash consideration is missing. This is your target. The cash consideration is missing. That's your target. Don't worry, you will get it. Now the next thing is, obviously 40 and 30 is 70, and as this is a full goodwill method, so definitely we need fair value of NCI. Now in this question, look at here. In this question, NCI means 30% shares. NCI means 30% means 3,000 shares. NCI means 30% shares. So how to calculate fair value of NCI? It's 3,000 shares times, they have already told in the question, they have already given indication, times the share price, that is 3.8. So 3,000 times 3.8. Can anybody please 3,000 please calculate it for me. 3,000 times 3.8, it's 11,400. Thank you. 11,400. Okay. Now you need to subtract less fair value of net assets of S company. The already net assets given in the question, wait, let me show you. The already net assets given in the question was, see this, 35741. See, this is the question. 35741 plus 600 was the fair value adjustment. 35741 plus 600. Can anybody add this? Can anybody do this for me? 36341. Thank you. 36341. Okay. Now, luckily we have the goodwill in this question. We already have the goodwill in this question. What is the number of goodwill? Let me check again. 2259. The number of goodwill is 2259 is your goodwill. 2259 is your goodwill. Now, my dear respected students, can anybody of you calculate this balancing number? Can anybody of you calculate this balancing number? Can anybody? Yes, it's 3,000. How? You can do reverse working. It's not a big deal. It's, you guys are professional students. So this is basically 3,000. Okay. And this is the balancing number, and that was the target. That was the target of this question, right? Not difficult at all, even in the examiner report, because this is the latest paper. So in the examiner report, they have discussed this paper. They have written it clearly that majority students scored good in this. scored good in this. Okay, this is all you have done in the class. Just thing is that they have given you goodwill this time, and they have told you to do back working, right? Okay, just backward working and cash consideration you need to calculate. Now the next thing, did you understand it? Please reply. Please reply on the chat box if you guys understood it. Okay, now we have to write how to calculate the goodwill, because they told you that how to write the note as well, how to calculate. Now the goodwill, let me write. Fair value of net assets of floor company is deducted from fair value of existing investment plus fair value of additional, we bought 30% more shares, additional consideration plus fair value of NCI plus fair value of NCI plus fair value of NCI, right? Okay, we need to deduct fair value of net asset from the sum of all these, now listen, look at here. In the requirement they asked one more thing. From you guys, that is the cash paid. How much cash we paid? Look at here, how much cash we paid 3,000. And now for this thing, you all must have knowledge of cash flow as well. You all must have knowledge of statement of cash flows, consolidated statement of cash flows. Can you guys tell me, we have given two types of consideration. Now one is shares consideration, and the other one is cash consideration. One is shares consideration and other one is cash consideration. Can you all think over it? The shares consideration is basically share exchange. So no cash flow in it. The shares consideration is basically share exchange, so no more physical cash in it. So it won't come in a statement of cash flow. But yes, cash consideration as you have paid, so this is a cash flow. This will go in investing activities. But very interesting thing, I hope you remember. Just think, let me give you one example. Can you see this box? Can you see this my Apple pencil box? For example, I am buying this box for 3,000. Listen, I just bought this box for 3,000. I paid 3,000 and I bought this box. But when I opened this box, I got some cash from it, 1,000. I bought this complete box for 3,000. I paid it. And when I opened it, I got 1,000 from inside. So that means effectively my cash flow is only 2,000. Getting? So now, as we just got the control, got the control of this company, and we paid initially 3,000. But see the question. Let me shift the screen. In this, look at here, in this company, how much cash in this company? 1 2 3 4. See, cash and cash equivalent is always there. 1 2 1 2 3 4 1 2 3 4. So we paid 3,000, and when we got this company, some cash already inside this company, some cash is already there inside this company. 1 2 3 4. So what is your net cash outflow? What is your net cash outflow? 3,000 minus 1 2 3 4. 3,000 less 1 2 3 4 1766. Very good. 1766 is the net cash outflow. You read the requirement. They have asked you this to write about it. You need to write about it. Listen. Floor company's books at the date of takeover. That's why the net cash flow, the net cash flow for this investment is 3,000 less 1 2 3 4. I think it's 1766. Okay, that's it. And this is old thing. You have done this before. You all have done this before. Okay, so that's the end of the first requirement. Now let me make you one entry. Let me make one entry for you guys. It will help you. In the next requirement. Wait, see this. Can you see this share exchange? And how many shares parent company issued? 1,500 shares. Look at here. How many shares parent company issued? It's 1,500 shares. So can anybody of you make the entry you used to make in your F7 exam, FR exam? The entry will be, let me make the entry. The entry for this 9,000, will be this. See this. Debit investment, because one company is buying shares of another company. Debit investment 9,000. Okay. And in return, parent company is not giving cash. Parent company is giving his own shares. Parent company is issuing his own shares, and I'm sure parent company is issuing 1,500 shares. So let us say the face value is $1. So 1,500 shares, multiply by 1. The ordinary share capital will be 1,500. The ordinary shares capital will be 1,500. And what's the difference? The difference is share premium. That is 7,500. Okay, so this is the entry. This is the entry of share issue. This is the entry of share issue. This 9,000 entry. See, this is the entry for this 9,000. Okay, this will be used in the next requirement, because the next requirement is cash flow. The next requirement is a statement of cash flow. Okay, right? So let me show you one last time. Let me show you one last time the complete data. This is roughly, I taught you first I taught you the sketch. First I taught you this all sketch. Hope you got it. Hope you got it. Then we discussed something, what we were doing. Then we calculate the carrying value. We calculated the carrying value of existing investment. We calculated the fair value. We made this entry. Don't forget the entries. This will be used in the next transaction. Then finally, the heart of this question, the heart of this question is this calculation C. Then we calculated goodwill. Then we calculated goodwill, right? And we write how, and then we wrote how did we calculate the goodwill. And finally, we discuss about the cash consideration as instructed by the examiner, as instructed by the examiner, as instructed by the examiner, right? Okay, got it. This was the end of first requirement. Are you guys with me? Are you guys with me? Kindly reply. Okay, the next requirement is more interesting, but one thing let me clear you that it's pure consolidated cash flow question. I'll try to go deeper and deeper, but you must have some knowledge of consolidated cash flow. Listen, now I'll be making different T accounts. I teach using T tables, or T accounts, right? So we'll be making account of intangible asset. Listen, we'll be making account of PPE. We'll be making account for investment in associate investment in associate. We'll be making account of NCI, right? Like all, we'll be making account of different investments. Okay, so in the T accounts you have to record, listen my words, you have to record each and every movement, in the T account. You need to record each and every movement. One movement I must want to bring in front of you. I hope I'm sure you guys remember about this. Listen, can you see this? Can you open your eyes? Open your eyes. This is the company we took over this year. This is the floor company we took over this year. And listen, look at my video. Look at my video. And when you take over one company, that company just come and do adding together with you. When you acquire a company, that company comes in your control, and that company just do adding together with you. That means that company's PPE added together with your PPE, that company's inventory is added together with your inventory, that company's intangible assets are added with your intangible assets. So by doing this transaction, your all balances moved, your all balances shakes. Just think, you are not getting. My dear student, you just acquired a running business, you just got the control, so this country will be added together. So this will shake all your balances. Use your brain. This will shake. See whatever, how many things are present here, how many things are there. Intangible assets. See, the first thing is they have intangible asset, they have PPE, cash. They have other net assets. Okay, so cash I have already discussed. So when I will be making, listen to me, when I will be making intangible asset account and PPE account, I will write these two numbers on the debit side, because we are buying this company. So this company must have shaken our balances. Okay, this is first thing. Second thing, listen, look at here. Just think, as on first of, see this date, on 1st of January X7, floor company was associate. Previously floor company was our associate, but from 1st July X7 onward, we said bye bye to associate accounting, we said goodbye to associate accounting, and we transferred associate into subsidiary. So the carrying value of investment in associate, this thing, see, this carrying value of investment in associate 14,800, this 14,800, the carrying value of investment in associate on the last day before takeover, this will be removed from our associate balances. this 14,800 will be removed from our total associate balances, because we said bye bye to this company. This company is no longer our associate. From 1st July X7 onwards, this company is your subsidiary. So definitely from investment and associate accounts, we'll say goodbye to this company. So this 14,800 will be thrown out. This 14,800 will be thrown out from investment and associate basket. Not getting. Okay, let's start and let's give a try. Okay, things, I know things, these are not basic papers, these are advanced papers. It's naturally difficult. Just keep this thing in your mind. Okay, it's difficult for everybody, not for you. Okay, now the next requirement. This is all about the statement of cash flow. Wait, let me read the last next requirement, 6. The real requirement of today's class. The objective of today's class is this requirement, B requirement. This B requirement. Prepare extracts of the cash flows generated from investing activities and financing activities. Only these two activities, as written by the examiner. Normally they won't ask complete cash flow from you now. Normally they won't ask complete cash flow from you now. They will be asking one or two activities. So in this question also, examiner is asking investing and financing activities, right? In the consolidated statement of cash flows for the sugar group for the year ended 30th June X8, see no see the instruction, no explanations are required in part B. This is luckily pure practical. This is pure 100% practical part. No need to write a single word of theory here. No need to write a single word of theory. No explanation required. Enjoy practical area. Okay, now read the question. Including in purchase of additional investment in floor company, which it correctly consolidated from 1st July X7. Obviously from 1st July onwards, X7 onwards, this is your subsidiary, so they have done correct. The sugar group also purchased various assets during the year. Now, then there were no disposals and no impairments of intangible assets during the year, but yes, there is amortization of 3.5. Don't forget this. Amortization normally reduces. Amortization normally reduces the intangible asset. So when you will be making the intangible asset account, when you will be making the intangible account, this amortization will come on the credit side. One extra thing just I want to tell you, the not part of this question, amortization is a non-cash expense. Amortization is a non-cash expense. So if you were making operating activities, you need to add back this non-cash expense. Okay, but right now in this question they don't ask operating activities, so leave it. So this will go in intangible asset account. Had been deducted from profit from operations, leave it. Now the only additions of PPE. Now guys, let's do it paragraph by paragraph. Just do concentrated work on each paragraph and then move on to the account. Okay, now wait, let me pack the intangible asset first. Can you see see this? This is 2007 and this is 2008. This is 2007 and this is 2008. So this is your opening intangible asset and this is your closing. Can you see 15865 and 33456? I request you all to take the pic of this, please. I request you all to take the pic of all of this, all things, so that you can easily follow me. Take the pic, okay, from your phone. So this is opening and closing of intangible. And one more thing, we just bought a subsidiary. See this, we just bought a subsidiary, and in that subsidiary there is some intangible asset 6781 plus the goodwill. Goodwill is also intangible asset. Goodwill is also intangible asset, the daddy of all intangible asset, right? Don't forget. So let me, this is 6781, this is 6781. Now you have already taken the picture of that. Okay, now let's move to this, the first account, the intangible asset account. Let's move to the intangible asset account. Let me do work for you. You have the picture, you can use your picture. You have the picture, you can use your picture. Let me do my work. uh Opening intangibles, opening intangible is 15865, right? The closing intangible asset is, the closing is 33456, double 3456. Okay, now how many, write each and everything which affects this account. Now when we bought floor company, floor company had some intangible assets. See the first page pick, so, and that was license, floor company license and other things, it was 6781. Now when we acquired floor company, the biggest intangible asset we bought is goodwill. So goodwill just came to us, just added to us. So definitely goodwill must have increased. Goodwill must have increased. Goodwill must have increased your total intangible assets. So goodwill floor, how much? It's what, 2259. This was 2259. Okay, now there is one thing which reduces your intangible asset, and that is amortization. My dear student, look at here. And amortization was 3.5 million. Amortization was 3.5 million. Now just think, everything, each and everything, what max you can find from this question you just did. Still there is some balancing figure on the debit side. Still there is some balancing figure on the debit side here. And this will be your cash additions. This will be your cash additions. Can anybody tell me what is the number? Can anybody tell me the cash addition number? My dear students, please do it. Thank you. 12051 is the balancing number. 12051 is the balancing number. And now look at me. You paid cash to buy this intangible asset. Intangible assets are non-current assets. So this will go as an outflow. This will go as an outflow in investing activities. This will go as an outflow in investing activities. Be confident. Be confident. You will do it. Be confident. You will do it. Don't worry. Okay. Now, let me write this in the cash flow statement, in the statement of cash flows investing activities. Wait. So first of all, net cash paid to acquisition of floor company. You remember you paid 3,000, less how much? 1234, 3,000 less 1234, 1766. 1766, right? Okay, then cash paid to acquire intangible asset is 120, just we did 12051, sorry, this is one. Okay, 12051, 12051, 12051. These two things I have done in investing activities. Just to save our time of writing, I have already written all the headings. Okay, the objective is not to teach you how to write these. Okay, two things we have already found two things now. The net cash paid to the acquisition of floor company, which is done in requirement number 1, and intangible asset we just worked out. Intangible asset we just worked out. Okay, now wait. Now let's go to the question again. The second paragraph, the only, see this paragraph. Now we are going to do this paragraph. See this. Be confident. The only addition to the property, plant, and equipment during the year was as a result of the acquisition of floor company. acquisition of floor company. Okay, now that means whatever we acquired through floor company, that is our only addition, no more additions. The group disposed of some plant and machinery at a loss on disposal of 2 million. Now wait, loss on disposal is given but carrying value is not given. Loss on disposal is given but carrying value is not given. We'll calculate it. The loss on disposal of that disposal transaction is given but carrying value is not given. We will calculate it through the movements of account. Don't worry, we are expert. Now depreciation deducted from the profit. Depreciation expense is 10 million. So my respected dear students, we need to make a PPE NBV account. We need to make a PPE carrying value or NBV account, and we'll do it. Okay, so look at this once. You have already taken the pictures I have told you. Now with this company, how much PPE you got? 18076. With this company, how much PPE you got? With this company, how much PPE you got? You got 18076. That will be recorded in your account. Okay, and now let's see the opening and closing balance. The opening and closing balances are the opening and closing balances are the opening and closing balances are this and this 52818 and 55124. No issue. Let me make the PPE account now. Let me make the PPE account for you guys. Let me make the PPE account. What is the opening balance of PPE? The opening balance is 52818. 52818. Okay, the closing balance is 55124. Yes, additions with that subsidiary, addition with subsidiary floor, right? When we acquired floor company brought how much assets? That was 18676. 18676. Please see the. Okay, now as this is PP and BV account, the carrying value is given. So depreciation expense comes here. Depreciation expense was, I think, 10,000. Depreciation expense was, I think, 10,000, right? Okay. Now, can you tell me, listen, first of all, it's 18676. Wait, let me check. We did 600 fair value adjustment. Listen, we did 600 fair value adjustment. There is one guy asked the question. Listen, for property plant and equipment, here it is written 18076. Sorry, wait, 18076. Can you see this? 18076. But we also did 600 fair value adjustment. We also did 600 fair value adjustment of land, and land comes in PPE. So whenever, listen to me, whenever you acquire any company, whenever you acquire any subsidiary, you immediately bring all assets to fair value. So fair value adjustment is 600. So 18076 plus 600. 18076 plus 600. Can you see this? Thank you. If you want to write the note, you can write like this: 18076 plus 600. Thank you. Right now, there is no balancing figure this time on the debit side. There should be no balancing figure on the debit side. You can check. Obviously, no other addition. In the question, it was clearly written there were no additions. So definitely now this is the disposal number. Disposal NBV. Okay, as this is the NBV account, so this balancing figure we'll get as a disposal NBV. Can anybody calculate the disposal NBV for me? Can anybody calculate the disposal NBV for me? 5770. Can you check it again? 6370. This is the balancing number. Okay, this is the balancing number. Now hold a minute. 6370 is your disposals NBV. 6370 is your disposals NBV. 6370 is your disposals NBV. Now this is the disposal NBV, and when you sold this asset, NBV is 6370 at the date of disposal, and you got a loss on disposal of 2000. When you sold it, you got a loss on disposal of 2000. In the question it is written. So can you tell me how much cash you physically received? Cash received on disposal, cash received on disposal must be 4370. 4370. Can you understand this? I repeat, NBV at the date of disposal is 6370, but when you sold it, you got loss on disposal. So definitely you got the low cash, you get low cash. So 4370 is basically cash received. 4370 is basically cash received. Okay. Now students, look at this account. In this account, there are no cash flows except for this. Except for this thing. Except for this thing, there is no other cash flows. This addition relate to the subsidiary addition. We have already paid for the subsidiary. We have already paid one shot for the subsidiary. So this 18676 is not a cash flow. Second thing is depreciation expense. Depreciation expense is also not a cash flow. Depreciation expense is also not a cash flow. So only disposal cash flow will be added. Only disposal cash flow will be added in investing activities. That is 4370. That is 4370. Now let me write. See this. Okay. 4370. It proceeds from disposal of PPE. Proceeds from disposal of PPE. Proceeds from disposal of PPE. 4370. 4370. Right. We have done few adjustments. Few adjustments we have already done. Now, next thing. Let's move to the question again. You remember the first line. If you have the question pick, they told you on 1st of October. Listen. They told you on 1st of October, you bought one more new associate. You bought one more new associate for 5,000. Butter company. You bought butter company. Remember they told you. So that is also an investment. See, sugar company purchase. See this line. Sugar company purchased 25%. This is new associate and this is proper cash flow. In butter company on 1st October 07 for 5 million cash. See, this is your outflow. It must go in investing activities. Yes, this will go in investing activities. Don't worry, I'll write. Not only this will go in investing activities. Wait, not only this will go in investing activities, but one more place. You what entry you will make for this? You will make entry this for this 5 million. The entry will be investment debit, investment in associate debit 5,000 and cash credit 5,000. Listen, dear students, whenever you buy associate shares, you make this entry: debit investment in associate 5,000 and credit cash 5,000. Okay, so this will also impact the associate account. When I'll be making the investment in associate account, this 5,000 will also go. This 5,000 will also go in investment in associate account, not only in the investing activities but also in the investment in associate account. And in this way we'll be finding some balancing numbers. Okay, now one more thing, which gave significant influence. Butter company paid a dividend. That means associate gave some dividends to us. So this is an inflow for us, and this inflow must be recorded in investing activities. Butter company paid a dividend in the post-acquisition period. Sugar company also received dividends from other associate during the year. See, this is the real thing. The dividends are missing. Dividends from associate are missing, which we can easily calculate it. So my dear student, now our objective is to make associate account. Easily we can make it, easily. Opening and closing balances of our associate is given. Opening and closing balances of associate is given. One thing, the new associate we bought it for 5 million, this is also given. Third thing, floor company, we kicked out floor company 14,800 from our associate basket. We kicked out associate company during the year from our associate basket. So that movement will also be recorded. Step acquisition, the requirement number one. And one last thing, I hope you remember, I hope you have done this topic, the post profits of associate company. The post profits of associate company also affects the carrying value of investment in associate. The post profits of associate company, think over it, also affects the carrying value of investment in associate. Just giving you 1 minute to think over it. It's your right. Think over it, settle it, take out your register. You have your registers, you have your copies, papers. You have done something related to consolidated cash flow. Now listen, let me show you the opening balances. See, this is the opening balance of investment in associate. Opening and closing, can you see? One more thing, see, this is the one excellent thing, share of profit from associate companies. This is very good thing. Yes, I'm giving a break, just 1 or 2 minutes. After 1 or 2 minutes I'll give break. See, this is the share from associate companies, share of profit also affect the carrying values. Okay, so now let me make the account. I'm sure you have that question with you. The opening balance of investment in associate from the question SOFP. The opening balance from the investment in 23194. The closing balance is 26328. Okay, now as during the year you did some step acquisition, you threw away floor company. Okay, so floor company step acquisition. And what was the last day valuation was 14,800. You remember the carrying value at the time of on the last day, when we were saying bye bye, to this company. Now this COI, what was the name of this new company? Butter. Yes, COI butter company. We bought new butter company for 5,000. Right. And one more thing, they have given you the associate share of profit. The profit, not loss, profit. Associates are in profits. So post profit share of associate always increases the associate. How much it was? I think 15187. Now, finally, the last thing. Let me use the red pen. Dividends from associate. Dividends. When you take out dividends from associate, your value of investment goes down. You are taking out. You are eating up. When you are listen to me. When you are taking out investment, when you are taking out dividends from investment in associate, basically you are eating up. You are eating up your investment. So your investment will go down. So dividends from associate always come on the credit side. Can anybody do this for me? 2253. Thank you. Okay, now my dear student, very basic answer question for you. From this account, how many things will go in the statement of cash flow in investing activities? See, this thing, this thing, this thing, this you paid cash for buying this associate. So this will be a negative in investing activities, negative in investing activities. Okay, and as these dividends are basically fruit of investment, return of investment, so this will go as a positive in investing activities. In investing, this will go as a positive in investing activities. Okay, it's easy, not difficult, not difficult. If you have attended the normal course classes, we have done many questions in the class. So now let's post it. Cash paid to the acquisition, this is 5,000, and this one is 2253. Dividend received is inflow 2253. Dividend received is basically 2253, 2253. Okay, my dear students, I am asking to all of you one question. How is the progress going till now? How is the progress going till now? Please reply on the chat box, all of you. That's my tip. Give me some tip. That's my tip. Give me some tip. Reply on the chat box. On the chat box, there is a chat box. Are you getting everything? Please. All of you write. All of you write, please. It won't cost you. It won't cost you. All of you, please. Okay, let's take a 5 minutes break. 5 minutes break. Just refresh yourself. 5 minutes, 5 minutes, 5 minutes break. Okay, and then we'll come. Then we'll come and we'll start. 5 minutes break. Don't leave the session. Don't leave the meeting. Just a 5 minutes break. Okay, you refresh yourself. Now we did till associate, right? So now we are moving towards the next thing. We are moving towards the next thing, and that is, yes, fair value through PNL. Fair value through PNL. Sometimes we buy big investments like control. We get control. That's the highest level of investment. Sometimes we get significant influence. That's associate, and sometimes trade investment. IFRS 9. Now, the next paragraph is related to trade investment. The next paragraph is related to trade investment. Trade investment. Listen, there were no acquisitions of investments. There were no acquisitions of investment measured at fair value through P&L. That means we didn't buy any new shares. We didn't buy any new shares in fair value through P&L during the year. But yes, there were some disposal. That means the cash is coming in. The cash must come in, which had carrying amount of 4 million. Okay. At the date of disposal, the final value, carrying value is 4 million. Don't forget, carrying value is 4 million. And they were sold at a profit of 500. Very easy. The carrying value finally was 4,004,000, but when we sold it we got gain of 500. So automatically 4,500 is the cash received. 4,500 is the cash received. Very simple. The final day carrying value of investment at the date of disposal is 4,000, but when we sold it for gain. So definitely the cash received must be 4,500. Okay, so this is your inflow. Don't forget, this is your inflow. Don't forget. Which was the most technical data in my eyes for this question. These were sold at a profit of 500. These were sold at a profit of 500, which was included alongside the fair value gains, because fair value gains means this fair value through PNL. The fair value through PNL, if there is an upward fair value change, we book it in PNL. In this category, all fair value change also goes in P&L. So read this. These were sold at a profit of 500, which was included alongside, the word alongside, don't forget, the fair value gains in investment income in the consolidated statement of profit and loss. There is a head, of investment income. I'll show you, they have given you. The investment income figure also includes dividend received from these investments. Listen, we not only receive dividends from associate, but we also receive dividends from trade investment. If you buy shares from stock market, normal shares, if you buy normal shares from stock market, you also get dividends. So these investments also given us dividends. These investments also gave us some dividends, which you have to calculate through balancing number, which you have to calculate through a balancing number. Any fair value gains or losses recognized in the initial investment in floor company. One more thing is included. See, any fair value gains or losses. You remember the 400 entry when we were changing the status, when we were changing, especially that's why I made the entry. When we were changing the status from associate to subsidiary, when we were changing the status from associate to subsidiary, we made one entry, investment debit and P&L credit. I'll show you 400. That 400 is also included in investment income. That 400 is also included in investment income. There is one investment income head. I'll show you. I request you all to read these 4 lines. This is technical lines, and help me in this. Okay, now listen. Check the income. See this. This is the number. This is the number I'm talking about. See this. This is investment income 3891. 3891. This investment income. This investment income is 3891. 3891. 3891. Okay. I'll show you the working. Don't worry. This investment income includes many things. This investment income includes the 500 gain on disposal. This investment income includes the fair value change of fair value through P&L. This also includes that 400. This all 3891 also includes that 400 initially shifting at the time of associate to subsidiary step acquisition shifting entry. This includes many things. And one last thing this includes is dividends from these companies, dividends from these investments. Okay. So I'll be calculating balancing numbers. Don't worry, I'll do it. Now, can you tell me the financial assets, opening balance of financial asset? See this opening balance of financial asset 6,000 and 3,000. Somebody wants to take the pick? Yes, take it. Come on, quick. If somebody wants to take the pick, take it, please. Now I'm moving towards the solution. Thank you. This is investment at fair value through P&L. Okay, see this account. Opening balance is 6,000. Closing balance is 3,000. Now, during there is a disposal. There is no addition. They have openly told you there is no addition, no more new buying. See this. There is disposal, and at the time of disposal, the carrying value is 4,000. Okay, at the time of disposal, the carrying value is 4,000. Now, a kid can understand that this account is not balanced. This account is not balanced. See, on the credit side, it's 4 plus 3, 7. On the debit side is 6. So there is a balancing number of 1,000 here. There is a balancing number of 1,000 here. Students, do you think this 1,000 is new buying of shares? This 1,000 is new buying, new addition of shares? No, they have strictly said no for this. Now, what is this? See the category. What's the category? The category is fair value through P&L. So in fair value through P&L, you need to bring your investment to fair value. So this is basically fair value gain. This is basically, this 1000 is fair value gain. And what should be the entry for this 1000? The entry for this 1000 is, the entry for this 1000 is investment debit, 1000 and P&L credit 1000. Investment debit 1000 and P&L credit 1000. Debit investment 1000 and credit P&L 1000. Okay, don't forget this. This will be used. And now one more extra step. This 4000 is the disposal. This 4000 is the disposal, right? And when we sold, let me make the entry for this. When we sold it, we got 4500. We got 4500. I already taught you this in question. 45, wait, sorry. Yes, I'll send you the notes. I'll send you the notes. Don't worry. You don't need to write. I'll send you the notes. Cash debit 4500, investment credit 4000. This is the entry. And the P&L, the gain on disposal is 500. Those students who love making the entries, they can see this entries. Those students who like entries, they can do this. And without entries, I have done in the question. So these are the few things related to this account. Now as a student, you may ask, sir, what will we post in the statement of cash flows? Investing activities. Investing activities, only this 4500 right now. Investing activities right now, only this 4500 as an inflow. Now one very excellent thing. I love that thing. Listen, I just told you this investment income. Students, please look at here. I just told you this investment income 3981 includes few things. The first thing is 500 gain on disposal. The second thing is 1000, the fair value movement. Just showed you that in from the account the balancing number was 1000. Okay, and then this also includes the 400 step acquisition. This is step acquisition. Okay, this 3891, you can read the theory. This 3891 includes the gain on disposal 500. This includes the fair value difference. This includes the fair value difference, right? This includes the 400. This includes the 400 step acquisition gain. So if you remove these all, if you remove these all from this 3891, the balancing number will be your dividends. The balancing number will be dividends received. The balancing number will be dividends received from these investments. Let me do it in a fair way. Wait. Total investment income, it's 3891. 3891 is the total investment income. 38 less step acquisition floor gain. How much? 400 less gain on disposal. Gain on disposal, we just did fair value through P&L investment. 500 less fair value gain, fair value movement gain, fair value through P&L. This one, wait, this entry 1000. So automatically the balancing number will be dividends received from these investments. How much is this? This number is 1991. And yes, this dividend received, this is a cash flow. It will be added in investing activities. This will be a cash flow, so it will be added in investing activities. Look at the screen. It will be added in investing activities. Okay, 1991. Now, wait, let me add these in finally in the, how much is this? Proceeds from disposal of fair value through P&L is 4,500. This is inflow, and investment income received is 1991. Okay, 1991. That's your total. That's the final thing. That's the final thing. No need to calculate the total as well. That's it. That's enough. They just want the line item. They just want the line item. They don't want the totals. Okay. So we just did investing activities. We just did investing activities, dear students. Now for financing activities, look at me. Look at me. For financing activities, what comes in financing activities? All financing cash flows. Normally issue of shares. One question, 4 million. The gain of 4,000. Wait, this is this one. This one. Look at here. This 400. This is 400. One student is asking about the 400. The 400 gain is 14,800 and okay. Got it? Thank you. Now, in financing activities, students listen. In financing activities, we write the issue of shares. In financing activities, we write the issue of shares inflow. If you have issued any shares and you got the cash, you'll write in financing activities. If you have taken loan or if you have repaid loan, if you have taken loan or repaid loan in financing activities, and if you have given ordinary dividends, if you have given ordinary dividends, definitely listen. If S company is giving dividends, so S company gave some dividends to parent company, that's within the group, and S company gave some dividends to Ncaa, that is relevant for group. You guys are not getting. Wait, I'll explain you dividends in detail. I'll explain you dividend topic in detail. For those who forgot it, I'll explain, don't worry. So first of all, proceeds from issue of shares. We need to calculate proceeds from issue of shares, and I'll be using the method like you did in F7 paper. If you have studied cash flow statement in F7 time, you can understand my working as well. Wait, do you remember in this question, all of you please, all of you, in this question, see this, in this question, during the takeover on the first day of accounting period, we did takeover of floor company. We got control of floor company, and for getting that control, we issued our shares. See this, for getting the control, we did some sort of see this, we did some sort of shares consideration. That means we issued some shares in exchange of shares. We got some shares of PS company and we issued our shares as well. So this entry, see this, investment debit, share capital credit, and share premium credit. So this share capital and share premium must have increased, must have been posted in the SOFP. This share capital and share premium issued by P company must have been posted in the SOFP. So this must have moved. This must have moved your share capital and share premium. And this is not a cash flow. Open your eyes. There is no cash in it. This is pure share exchange. This is pure share exchange. So I'll be posting it. Okay. Now, second thing, can you see this? See the question. Can you see the equity side of your question? You have opening share capital of 20 and closing of 23. Opening and closing share capital, and there is one more thing, other component of equity, and they have openly told you this is all share premium. Other component of equity is share premium. Don't sleep, please. We are very close to success. We are very close to the end of the question. Listen, share premium opening is 18 and closing is 33,600. One method is that you can easily add these two. You can add these two and solve, and you can even do in two columns as well. You add these two, share capital and share premium opening balance, and then share capital and share premium closing balance. In this way you can also do. Okay, this is also the examiner's approach is that. But when you guys were young and when you guys were doing F7, you used to make 2 columns. Okay, let me solve it for you. Let me solve it for you. You will understand. I'm sure you will understand. You will get it for sure. See this. I hope you remember this working. See my screen. When you guys were in F7, you used to make this 2 columns, share capital and share premium, opening and closing. Now, opening share capital is 20,000, closing is 23. Opening share premium is 20, wait, is 18, and closing share premium is 33,600. Okay, you can also do it like that. You can add both of them. Okay, now what movements have been done during the year? One movement is share exchange. Floor company. Remember, at the beginning of the year, at the time of takeover, there was some share exchange. And what was the entry? We credit share capital by 1500. I just showed you the entry. We credit the share capital by 1500 and 7500 is the share premium. Now, students, please look at here. Now there is some balancing figure left. This balancing figure is basically cash issue. Can anybody of you calculate the balancing numbers? Wait, 20,000 plus 1500 is 21,500. 20,000 plus 1500 is 21,500. How much should I add? In 21,500 to get 23? This will be 1500. Okay, and 18,000 plus 7,500 is, this is I think 25,500. How much should I add in 25,500 to get 33,600? Come on, tell me the balancing figure of share premium. 8,100. My dear student, this balancing figure is cash issue, and those who love double entries, let me make this entry for you. Just for the love of double entries, you will credit the share capital by 1500, you will credit the premium by 8,100, and then you write the debit bank. 81 plus 15 is 9,600. Enjoy. This is the cash flow. This much cash you receive from issuing shares during the year. This is a real cash flow of financing activities. This will go in financing activities as an inflow. You understood it? Tell me. You understood it? This is present in F7 kit as well. Sometime examiner tests the basic concept. Hello. Okay. Thank you. Now wait, let me post. See this. Proceeds from issue of shares. How much is this? 9,600. This is the inflow. Proceeds from issue of shares is 9,600. This is basically your inflow. Okay. Now, dividends. One thing is left. Dividends paid. Let me explain you one great concept. One great concept. Listen. Listen this. This is P company. This is S company. And this is NCI. Okay. Now wait. P company holds 70%. NCI hold 30%. Okay. Now, You know, when you make group cash flow, whenever you do group accounts, you think the whole structure as a group. Okay, you have to prepare accounts for this group. See, this is the group, this circle is the group, right? So just think, when S company is giving dividend, when S company is giving dividends, so S company, let us say S company is giving 1000 dividend. For example, S company is giving 1000 dividend. So S company will give dividend to all shareholders. So 30%, that is 300 dividend, will go to NCI, and 700 dividend will go to P company. Out of this, just for example, out of this total dividend of worth 1000, 30% will go to NCI and 70% will go to P company. Okay, so from the group point of view, this 700, this inside transfer, this is just change of pockets. S company to P company dividends are not real dividends from group point of view. So we never record this. We never record this in group cash flow. Only this dividends is recorded. And yes, one more dividend. If P company has this, P company has their own investors. So if P company is giving dividends, if P company is giving dividends to their shareholder, that's also a real cash flow. That's money going out of the group. That's money going out of the group. So that is real dividend. So how many dividends are real? This one is real, and this one is real. This inside thing is not, that not recorded in the group cash flow. Okay. Now, in this question, if you read the theory of question, they have openly told you, openly, sugar company is a parent company. Parent company is not giving any dividend to their own shareholders. In this question, parent company is not giving any dividend to their own shareholders, so there is no dividend like this. But yes, there is some NCI dividend. There is some NCI dividend which we have to calculate. There is some NCI dividends which we have to calculate. Okay. And that will be very interesting. That will be very interesting and very good learning. Very good learning. Please look at me. Let me go to the question. Now wait. What's the opening balance of NCI? What's the opening balance of NCI? Students, please. Opening balance of NCI is, these are the opening and closing. Opening and closing NCI is given. I'll make the account. NCI is the part of equity. NCI is the part of equities. Listen, they are also owners. NCI guys are also owners, so they are part of equity. Okay, so that's the ready-made opening and ready-made closing. Now, what things affect the NCI? That during the year profits, during the profit attributable to this will also increase the NCI, because if S company is earning, if S company is making profit, so NCI guys are also owners. NCI guys are also owners of S company. NCI guys are also owner of S company, right? NCI guys are also owner of S company. So definitely, if S company is making profit, NCI guys will earn, and their share will increase. Their share will increase. So this 9162 will increase your NCI. Will increase your NCI. One more thing will increase your NCI. Just think, very, very interesting. You know, on the first day, on the first day of this accounting period, you acquired. On the first day of this accounting period, you acquired that floor company, right? So when you acquired that floor company, on that day, the consolidation accounting, you gave birth to consolidation accounting. You gave birth to consolidation accounting. And when you gave birth to consolidation accounting, NCI also goes up. And you remember the fair value of NCI we calculated. You remember the fair value of NCI we calculated through share price. Through $3.8 share price. What's your memory? You guys forgot everything. I repeat. Listen, in NCI account, dear students, dear respected students, in NCI account, we have to write each and every movement. Whatever account you are making, you have to write the movement. That's the game of cash flow. So during the year, on the first day of accounting period, when you acquired floor company, so that means you gave birth to NCI as well. So NCI increased. I think that was 11,000 something. I think that was 11,000 something, 11,400. Okay. So that must affect the NCI. So now we can easily make the NCI account. And NCI is the part of equity. Huh? NCI is the part of equity. Okay, let me make it for you. See this NCI. What's the opening balance of NCI? It's 12914. 12914. What's the closing balance of NCI? It's 30152. Now, how many things increased the NCI? NCI is the part of equity. So if it is going up, you need to credit it. So the profit share of NCI must increase, and it was, I think, 9162, ready made from the question. And then floor company acquisition. We acquired floor company, and you can see 11,400 was the fair value of NCI at acquisition, and that is added to this NCI packet. That is added to this NCI packet. Okay. So now few things decrease the NCI. When you give dividends to NCI, that means the NCI share is going down because the S company's equity is going down. When you take out dividends from something, that thing goes down. So this is dividends paid to NCI. Can anybody tell me the amount? This is yes. Question major part is done. Thank God. Now in this whole account, there is only one thing which is a cash flow. In this whole account, there's only one thing which is a cash flow, and that is 3324. 3324. Okay, let's write 3324. Okay. So, and there is nothing written about the loan notes. There is nothing written about the loan notes, so you can't do it. That means the examiner is silent about the loan notes. So that's the end of requirement number B. That's the end of requirement number B. Now requirement C is free marks. I must say this is from your history. Requirement C is from your history. They repeat this question. Simple words. Free marks. It's related to IS 19. Requirement C is related to IS 19 employee benefit plus cash flow. The treatment of IS 19 employee benefits, defined benefit pension plan, in a cash statement of cash flow question. That's it. That's the requirement. See this. Sugar company. I'll try to teach in detail. Don't worry, and just be energetic. I'll explain you. I'll recall you the treatment, everything. Sugar company is the only entity in the group which operates a defined benefit pension plan. Hope you remember the meaning of defined benefit pension plan. There are two pension plans. One is defined contribution and the other one is defined benefit. In defined contribution plan, the major risk is with employee. Employee bears the major risk. But in defined benefit plan, employer bears the major risk. In defined benefit plan, employer bears the major risk. Now, the pension scheme obligation increased during the year from 1.175 to 6.368. This is the net increase in pension. Hope you remember the three columns. Normally when I teach through three columns: DBO, plan asset, and net. DBO, plan asset, and net column. The most important column is net. So the increase in the net column is 1.175 from 1.175 million to 6.368 million. This is the net increase. Now, the movement of the pension liability represents the service cost, current service cost. This is your expense. Current service cost is your expense. The net interest component, the unwinding of discount, majorly the unwinding of discount, interest expense debit and liability credit. Also the remeasurement component because of the changes of actuarial assumptions, I hope you remember, remeasurement component goes in OCI, not in PNL. Remeasurement component goes in OCI, not in PNL. Sugar company usually makes cash contributions into the scheme. This is the real cash flow. This is the real cash flow. Real cash flow by employer. Sugar company usually makes cash contribution into the scheme on an annual basis towards the year end. This is the real cash flow. The significant increase in the pension scheme obligation for the year ended 30th June X8 was because the contributions to the scheme did not follow normal practice and were instead made in July after the year end next year. So that means there is no cash flow. There is no cash flow now because you didn't pay. In the year end. You didn't pay on 30th June X8. You paid in the next month. That means it's accrued. At the year end. Okay. Benefits paid means, in routine there are some employees who are getting retired, so we give them benefits. Paid during the year were 2 million in cash. Just as a quiz, I'm asking, do you know the entry of benefits paid? This is the entry. DBO debit 2 million and plan asset credit 2 million. DBO debit 2 million and plan asset credit 2 million. This is not a difficult IS. This is the IS to score. This is the standard to score. DBO debit, plan asset credit. Benefits paid means plan asset. You are paying from plan asset. It's not going out from your own pocket. It's going out from that plan asset. The fund. The fund is a separate independent company. It's not going out from your pocket. Okay, so this is all general things I'm telling you. We all teachers teach this in class. These all things are taught by teachers in the class. This is routine question, nothing else. Now read. C requirement. Describe the impact, if any, that the defined benefit pension scheme will have on the consolidated statement of cash flow. You just need to tell the treatments, how to account for the sugar group for the year ended 30th June X8, assuming that the cash flows from operating activities are calculated using indirect method. Yes, in class you study indirect method. And in indirect method, listen, in indirect method, operating activities, we start from PBT. In indirect method, operating activities, we start from PBT and we convert PBT into cash flow. There is a journey which starts from PBT and that ends on cash flow. PBT to cash flow. I hope you remember it. Now just read it once, then I'll move. Now, just for your understanding, I'm teaching you, I'm recalling you the columns. Just for you remember the three column in IS 19, DBO, plan asset and net. DBO, plan asset and net column. Listen, opening balances and then you write interest expense. See, this is interest expense. The entry for interest expense is this. Wait. This interest expense is basically unwinding of discount, interest expense debit and net DBO credit. Can you see this? This is the entry for interest expense. All of you, please. And then you have current service cost. Leave the past service cost. Leave the past service cost. In this question, there is no. The entry for current service cost is P&L debit and DBO credit. Remember, see, the current service cost increases your DBO. The current service cost increases your DBO. So for those who are still alive, these two are non-cash expenses. They both of them are non-cash. These are non-cash expenses. These are non-cash expenses. See, in these two entries, my dear students, please look at here. These two entries, the first one is interest expense entry, the unwinding of discount, interest expense debit, DBO credit, no cash. It's a non-cash expense. And the second entry, current service cost, P&L debit, DBO credit, again, it's a non-cash expense. And my dear students, you have been studying cash flow for last 1 or 2 years. In your F3 paper you study cash flow, then in your F7 paper you study cash flow, and now in your SBR paper you study cash flow. So the basic concept is still same. So these two expenses are non-cash expenses. These two expenses are non-cash expense, and we need to add back in cash flow statement. We need to add back all non-cash expenses in operating activities. We need to add back all non-cash expenses in operating activities. You don't need to do like this in exam. Just for teaching purpose I'm doing this. Just for teaching purpose I'm doing this. This is a theory requirement. So students, operating activities, you start with PBT. Remember, in operating activities you start with PBT. So how you will do it? You will add back the current service cost, CSC, and obviously you will add back the interest expense. You will add back the interest expense, but don't forget this interest expense is sometime included in the finance cost element. This interest expense is sometime included, sometimes or every time, sorry. This interest expense is included in finance cost packet. So while calculating the interest paid, in that question, be very careful to remove this unwinding of discount from that finance cost packet. Otherwise your interest paid will be a wrong number. You will be ending up in calculating a wrong number of interest paid. So the first thing you need to do is add back all non-cash expenses. One more thing, I hope you remember, you have studied cash flow. In operating activities, when you go down, you come to cash generated from operations. And now the only cash flow sorry, the only cash flow for employer, we are employers, basically we are working in the books of employer. The only cash flow is contribution paid by employer, right? Whatever contribution employer pays in the scheme. So we deducted, see this, contribution paid by employer, contributions paid by employer, we deduct it from operating activities. Contributions paid by employer, we deduct it from operating activities. Okay, so very simple terms, in simple terms, you just add back all non-cash expenses like interest expense, like current service cost, even past service cost. Past service cost is also a non-cash expense. You add back all these non-cash expenses, right? You add back all these non-cash expenses, and then when you go to cash generated from operations, you just simply deduct the contribution paid by employer. This is the only cash flow. Now as a student you may ask, sir, what about the benefits paid? To employees? It's not your cash flow. It's not the cash flow of company. This is the cash flow of the fund. This is the cash flow of the pension fund, and that's a separate entity. That's not we, right? So, and you know the entry for that. benefits paid, remember the benefits paid are deducted from this column and this column, so the net impact is always nil. Net impact is always nil, remember, right? The entry for benefits paid is this DBO, sorry, and plan asset credit. So this is not your cash flow. And now one last thing. One last thing. Sir, what about, listen, there is a remeasurement component. There is a remeasurement component. Hope you remember the balancing numbers, the remeasurement gain or loss, the remeasurement gains or loss. Remember this? This goes in OCI. OCI. The remeasurement the remeasurement component goes in OCI. So wait, when I teach cash flow, I recall this many times. Remeasurement component goes in OCI. So first of all, is it a cash flow? No. Remeasurement component is not a cash flow. Is it a non-cash income? No. Is it a non-cash expense? No. So it won't go anywhere. It won't go anywhere because it is not a cash flow. Remeasurement component is not a cash flow, right? And it's not going through your P&L. It's not going through your P&L, even it's going through your OCI. So it won't affect your PBT. If you it won't affect your PBT, so remeasurement component won't come anywhere. Remeasurement component won't come anywhere. And this is the very basic training for cash flow. I repeatedly say this thing. Whenever there is something who is whenever there is a transaction which is not a cash flow, not a cash flow, and not going through P&L, not a cash flow and not going through P&L, so it won't come anywhere. It won't come anywhere in cash flow. It won't come anywhere in cash flow. Okay. Okay, let me write some points to you guys. I have already explained you. No. There is one question. Should we need to take into account interest income? No. This is net. And see this. These two things are netted off. This is net interest component. Thank you for this question. This is net interest component. Just we do it net. Okay. And as there is a liability in this question, net liability. So definitely this is net interest expense. As there is a net liability, that definitely this is interest expense. Okay. So whatever I explained you just need to write this. That's it. You'll get marks. Whatever I just explained you need to write it. That's it. And I would recommend you guys to do written practice. This is the issue. And once you start writing, the fear goes out. You won't have any fear then of writing. In define benefit plan, majority expenses are not sorry, cash expenses. Okay, like current service cost, past service cost, net interest component, so we need to add back these please listen, just few minutes are left, non cash expenses in operating activities as as we need to convert profit into cash flow, right? So we just explained examiner, we just explained examiner this thing, that these are the non-cash expenses which needed to be added back. Okay, right? And one more advice: the finance cost, care must be taken in calculating sorry in calculating the finance cost paid, because the net interest component is already added in income statement sorry income statement finance cost packet. Okay, these things I told you. These things I told you. Now, what is the only cash flow for this whole game? What is the only cash flow? The only cash flow is contribution paid. The only cash flow for sugar company is contribution paid by employer, and this is deducted this is deducted from operating activities after listen to me, it's not difficult, it's all practice. After cash generated from operations. Now, just explain the benefits paid. The benefits paid is not the cash flow of the company. The benefits, see this, the benefits paid to employee are not is not a cash flow for sugar company, as it is paid from plan asset. And just for your reference, if you want to make the entry, you can make a short entry here: DBO debit, okay? So there is no cash flow in it. Okay, now remeasurement component, as remeasurement component is not a cash flow and also it does not affect your P&L. That's why it won't come anywhere in state SOCF. in SOCF. Okay, it won't come anywhere in SOCF. Now one line is left, only one line. In this question, specifically to this question, they have not paid any contribution. The employer have not paid any contribution by the year end. So no cash flow will come. No physical cash flow will come. But yes, we need to add back the non-cash expenses. Now listen. Wait a minute. First look at this. Wait a minute. Wait. Giving you 1 minute to read. If anybody of you want to read, you can read it. Take your time. Now the last point, particular as sugar company has not paid any contributions into the plan by 30th June X8, so no line item, I use the line item of contribution paid is deducted from cash generated from operations. No need to do it, as we haven't paid by before the year end. From operations, but yes, we need to add back non-cash expenses. That's it. Still you need to add back the current service cost and all. Still you need to add back the current service cost and all. So current service cost and all. See, this is the requirement C. This is the requirement C. This is the requirement C. Okay, I tried my best to explain you the question. Even this is a revision class, but I tried to teach you like it's a normal class. Okay, so that you guys understand the concept of this topic. And this was a very good question. Okay, I hope you liked it, and we'll keep more classes before the exams. Okay, we'll be doing question number 2, 3 as well. We'll be doing question number 2, 3 as well. And kindly stay in touch through WhatsApp, right? Okay, I'll inform you most probably next Saturday, Sunday, both day. Next Saturday and next Sunday, both day, we'll keep classes, right? I'll send you this solution as well. Don't worry. I'll send you the solutions, and stay in touch. And if your friends or anybody wants to do the next class, I'll send you the recording as well. I'll send you the recording. You can forward it to your friends as well. Okay, so take care and best of luck for your exams. Thank you.